It's my great pleasure to open our conversation today, and we really hope to make it a conversation across both this initial discussion with Hanneke Smits of BNY Mellon, as well as the panels that follow. And it really is meant, as Todd suggested, to dig into some of the tough issues that are on the table and to understand what's going on in the world of sustainable finance, what's driving the interest in sustainable investing. And as you'll see in a few minutes in my conversation with Hanneke, I think we are gathered at a critical moment. A moment when you all know that the world community is coming together next week and the following week in Glasgow for the so-called Conference of the Parties, the 26th gathering of the nations that have signed on to the 1992 Framework Convention on Climate Change. And we are going to see, I think, in Glasgow, a renewed commitment to climate change action from most, if not all, of the countries of the world. And there will quickly be cascading from that new expectations for the business world. And I want to get into some of that with Hanneke, but that's really the backdrop to all of our discussions today. And I do think there's an interest in trying to be analytically rigorous about how this idea of the need to move towards a sustainable future, a deep decarbonization of our economy, a move towards a clean energy future, how that moves from a political conversation to a business conversation. And when it cascades to the corporate world, how that shapes the world of finance that sits right behind or right beside that corporate world. So there's lots on the table here today. We are in many regards, I think, at a watershed moment. And I do want to get into the details of what that means and how we as both scholars and practitioners manage that and how we study it, how we make sense of it. So with that, I would like to introduce my keynote speaker of the morning, our keynote speaker of the morning, Hanneke Smits, CEO of BNY Mellon Investment Management. And it's really a great pleasure to have Hanneke with me to kick off our discussion and our conference today. So Hanneke, thank you for being with us and thank you for your time. It's exciting for us to have you with us, given the central role you've played in thinking about some of the very important issues that are on the table. And I want to start just by saying there is a lot of interest. Todd suggests there's some pushback on sustainable finance, sustainable investing. I would argue the other side of that coin. What's amazing to me is how much interest there is. Yes, there are questions about whether we can really identify the sustainability leaders, whether we can separate real sustainability leadership performance from greenwashing or spin, and if we can really figure out how to make sure that the metrics we're relying upon allow us to make those choices. And we'll get into that in a moment. But I want to start with the big picture. And this is something that I know you've been looking at and thinking about from your several positions in the world of finance. But what's behind this growing interest in sustainable investing? And how deep or broad do you think it is? And is the industry that you're part of, the asset management industry, taking this on board or resisting? And frankly, is there growing sophistication? And I'm sorry, that's a couple of different questions, but I wanted to give you a chance to help set the stage here.
Well, thank you very much, Dan, and I'm delighted to be here with you. As Todd was articulating earlier, or I think you as well, it's such a pivotal time with also all eyes on COP26, which I believe you're attending next week then as well. So I have to say, I did in the intro comments, it struck me this perception of backlash or pushback to sustainable investing, because I'm with you. We would argue the other side of that. Just give you, before I get into the why we think this is happening, just to give a little bit of context for the audience. First of all, if you think about it, in 2020, ESG assets stood at $35 trillion. That's a lot. And we actually project that they will grow to around 50 trillion by 2025. And that would then represent about a third of professionally managed assets under management, which we believe by that time will be about 140 trillion. So that's a big number, right? It's also growing around the world, in particular in the three core regions of the US, the EU, and Asia. And then the question is really, why is this actually happening? right? Which is really your question. And I think there's sort of two things, but I would say one particular driver has been that the pandemic era has ushered actually in a fundamental awakening as to how society, the business community, and government are seeking or need to seek to address the environmental and social challenges of our day, which have all come much more to the fore. What we are seeing is that the end investor increasingly wants their personal values reflected in their portfolios, and those personal values focus very much on the need for collective action, in particular as it relates to climate change, but then also as it relates to certain social issues like equality of opportunity. So I think very much that the demand for collective action is here to stay and will be enduring, and is actually shifting the whole debate from what we would argue is, what has been shareholder primacy to stakeholder responsibility, which is different. And I think it's a different concept. It's taking on many forms. It means companies have to adapt as well. And I know we're going to get into that in terms of how they report, but we think it's not going away. We expect responsible investment to expand exponentially in the coming years, as investors very much are looking for outcomes in their portfolios that are not only good financial outcomes, but also need to create a benefit to society. Just want to pause here for a moment, because I think I've only answered 2 out of your 4 questions, and I have to say I've lost track of the other 2 and want to check in.
No, you're giving us just what we wanted, which is the big picture starting point. And I do think the current moment is one where society has begun to recognize that the business world has to operate from a different platform. And I think you've highlighted that. I do think that we're starting to see broad-based acceptance of the idea that the Milton Friedman world, that Friedman doctrine of shareholder primacy, that the corporate world should maximize profits so long as it's not illegal, is giving way to this broader sense of stakeholder responsibility, that companies do owe a debt of obligation to their employees, to their suppliers, to their customers, to the communities they operate in, and into society broadly. And that does seem to change the way business is being gauged. And frankly, it's changing what we might call the social license to operate. And I'm just wondering if you think that spills over to the finance world as something that the world of finance has got to pick up as well. And does it change how you think about which companies are the ones to invest in?
It's definitely, so this is definitely this is definitely spilling over into the finance world, and that's happening at 2 levels, right? First, we need to meet the increase in our clients' demands, and our clients are increasingly asking, as I just mentioned, for their almost personal values to also be reflected in their portfolios in ways that we quite frankly haven't seen before. But then secondly, as companies are setting themselves new targets, in particular with respect to how they're going to contribute to a path to net zero, right, and meet the goals of getting to net zero by 2050, and a lot of that has to be achieved, as you and I both know, by 2030. They need to publish plans, and then as active investors, or for the investor community, our role is to understand the plans, to challenge the plans, to evaluate them, and to understand whether those plans are actually going to lead to the targeted outcomes, and also to include that in financial analysis. So I think this is a trend that has already been on the way. Many organizations, including ourselves, have been including this focus on ESG factors in their analysis. But what is changing gradually is that there's more focus on responsible investing, which is and a shift from exclusionary investing, if you will, which is what often can happen when you think about ESG research-focused investing, to sustainable investing, and that is slightly different. So there's a lot to do for investors, but part of what needs to happen is also a better coordination and standardization of a framework around data. And I know we want to talk about that as well, so that investors like ourselves can evaluate those companies on a consistent basis, but that also ultimately also the end customer understands what it is that they're buying and what good looks like.
Well, you've really given us, I think, the core issues of the day, and that is to begin to understand how companies are dealing with the new expectations put to them. And I describe it as a sustainability imperative. It's no longer okay for companies to have business models that profit at the expense of society, whether that's putting air pollution up a smokestack or effluent out a pipeline or greenhouse gases into the atmosphere. And I think you're quite right. One of the first stories coming out of Glasgow is going to be the sort of global commitment, the emerging consensus that we need to have a net zero greenhouse gas emissions world by 2050. And the second story will be how that cascades from the political level to the company level. And one of the joys of our work over the last year from the Yale perspective with BNY Mellon has been the chance to dig into that issue of corporate net zero greenhouse gas emissions pledges. And I would encourage all of you who are interested in that topic to come in at the end of our program here. The first set of panels will include one where Nathan de Arribas-Sillier, who's my colleague, and I will present our work on this emerging issue of net zero greenhouse gas corporate commitments. And that's work that we have done with the help of BNY Mellon, and we've done a survey together that we'll begin to talk about today and will reveal in full glory next month. So there really is some empirical work starting to try to track down what's going on in that regard. I do want to ask you though, Hanneke, whether you've seen in the course of the pandemic, falling away of interest in these topics, building of interest. You know, I guess my hypothesis going in early on in the pandemic was that people were so focused on the health crisis and the economic crisis that spilled out of it, there'd be a falling away of interest. I'm now beginning to wonder whether it's not the opposite. We're seeing a growth of focus on sustainability. You can maybe tell us what the industry has seen in the way of funds. You mentioned early on that overall there's a big growth. What about during this pandemic moment? And you know, the political world is talking about build back better. That's not only Joe Biden's slogan, but Prince Charles talks about that. The World Economic Forum has a program around it. What's your sense of what the pandemic has done to this kind of longer term trend that you highlighted of people thinking about sustainable investing and now responsible investing as well?
So we've seen growth, and we've seen that on, you know, in a number of statistics. So first of all, we've seen sustainable investment assets continuing to grow in most regions through to 2020. Actually, interestingly, a lot of growth in Canada, but also good growth in the US, importantly, which actually has been catching up, I would say, with other regions. I think in reference to Build Back Better, what we've seen a lot of growth in sustainable debt, right? Sustainable debt offerings, financing some of these government type recovery efforts. And when you look at the sustainable debt markets, they've seen a lot of growth during the COVID crisis and are now standing at about 1.7 trillion, or that was at least at the end of 2020 and has grown since. Which I think is, you know, that's a very, very large number. Now, when we look specifically at flows, when it comes to what is needed for climate change, there I would say we haven't seen as much. It's still a little bit more of a trickle, and I think we need to see more. We've actually estimated that something along the lines of $90 trillion of truly green investment would be needed over the next 30 years to reach that net zero moment by 2050. Now you could, so that is then say back of the envelope, 3 trillion per year. And I know it's not going to happen like that. You probably need to plow in more earlier on, but let's just take that $3 trillion number. If we then look at what has happened, even though we've seen growth in sustainable funds, only about 30 billion, that's so about 1%, has been solely focused in flowing into climate funds, with other areas benefiting in more broadly based sustainable funds. So I'd say we've seen about 700 billion flowing into sustainable funds, but only 30 billion of that with a dedicated climate focus. So we're not quite yet where we need to be to actually solve the climate problem. There is growth in the overall sustainable flows, in regions, in different asset classes, and in focused funds.
I want to pick apart several pieces of what you've just given us to dig into. First, you've been watching this evolution for some time, going back to your time at Newton, a firm really known for its sustainable investing. But why do you think this has emerged with greater force and scale in Europe? You're mentioning Canada is now pretty strong, US is catching up. But what's the difference that has this kind of now fully mainstreamed in Europe and still, playing catch up in some other markets?
So I think when you look at Europe, first of all, European companies embraced ESG related reporting and goals much more readily and much earlier than in the US, right? So for example, climate action has been an objective for European companies for much longer, as has reporting on emissions is just an example, than we've seen in other regions. As a result of that, the EU, from a regulatory perspective, has also stepped in, right, and rolled out its regulation in March of this year, the Sustainable Finance Disclosure Regulation Initiative, which is having significant impacts on the ESG and responsible investment markets. Now, what we've also seen actually is that back to that pandemic, US investor demand has been catching up very, very quickly. And companies, regulators, as well as asset managers all together are moving together very quickly to meet demands. You just mentioned the current administration. It clearly has brought, even if the new plan is somewhat pared back, but it has brought a renewed focus on green investment, right, with a proposed plan to rebuild infrastructure, which will create demand for green bonds and impact bonds and so on and so forth. The regulators are also focusing on ensuring that they define better what ESG means. So it's back to those data. So while I think the EU is ahead, the US is catching up very fast. And then to the extent as to why it happened in Europe earlier, as I said, the companies embraced it earlier, might be rooted in a slightly different sort of socio-economic environment, slightly less capitalist in focus, as a broad generalization than what we've seen in the Anglo-Saxon world, that I think explains some of the root origins of this.
I do think you're right. And I think actually now the world broadly is shifting away from thinking that old Friedman doctrine is okay, that you can make money at any expense. And my own research is now focused on the idea that our foundations for capitalism, and I think this is broad, not just Europe, but the US and beyond, is going to be in effect a no uninternalized externalities model, to use the economics language. We're going to end up with it being not okay to have a business model that depends on spilling harm on others. And so for those who are interested, I did just publish a piece called the End Externalities Manifesto. And it's an argument for a different foundation for business, reflecting, Hanneke, what you're telling us, that the business world is moving towards a stakeholder responsibility model. And I do think the idea that you can found a business or run a business based on privatizing gains and socializing burdens or costs is not going to work going forward. It just can't be that your business is going to be allowed to go forward if it's causing harm to others. So I do think that's an interesting question. Let me dig back into for a moment your comments about the finance needed for climate change. I do think that's one of the top issues that's going to be on the table in Glasgow. You're highlighting some pretty big numbers that are headed towards sustainability broadly. The climate negotiators agreed 6 years ago in Paris to the idea that there needed to be $100 billion per year aimed toward the developing world. Now, the critical thing is, and still somewhat in debate, was whether that money was going to come from governments, although the language eventually used was that there would be that scale of capital mobilized to support the transition in the developing world to a clean energy future. The numbers that are being talked about as we go to Glasgow are that about $80 billion went to the developing world last year. So there's a bit of a shortfall. Some wonder if that needs to be met by governments putting forward more overseas development assistance. But I think the bigger crowd is saying, no, the gap is going to be filled by private capital. And it does strike me, and this is a question to follow up on your comments, how do we ensure that the money flowing into green investments isn't just broadly green, but does get to the transition required? And are we on track to getting the kind of funds at scale required to really move us to a sustainable future, to a deep decarbonization that I think is now emerging as a consensus of being necessary over the next few decades?
Yeah, this is then the challenge of free markets and more capital flows and meeting the demands that we all see and agree to, right? I think that first what does need to happen is that at COP26, a deal does need to be struck that countries can agree to, that is going to set some tangible targets and action plans from which then companies can determine their goals and investors can, and therefore their needs as well when it comes to raising capital, and then investors can determine how they're actually going to allocate that capital. Now, it could be that governments may need to support some of their choices or directives with some investment, either by providing incentives or by providing investment directly into what is needed to plug the gap. There's sort of different ways of doing this, right? Whether you create incentives or raise taxes on carbon pricing, there's sort of different ways that governments can actually influence how capital is being allocated. But ultimately, I think the fundamental challenge then is that right now, and I think, you know, I'm not going to steal the thunder of your paper, but when you and I prepared for today, we had this very interesting conversation around the challenge that companies today are disclosing on a voluntary basis versus a mandatory basis, because the countries have not agreed and policies have not been set consistently around the world so that we can move to this target. And that presents a huge challenge. So companies, you know, deliver pledges, the investor community included, but the pledges come in different forms and types. And then the second challenge is they're reported on in a different manner, right? And then therefore it makes it very difficult as a capital allocator then as well to allocate the capital. Now, then you get into engagement, and clearly it's part of our role as active investors to engage with companies to understand that better. But without that standardized framework that I do think is going to have to be set by governments and regulators, it's going to be very difficult to plug that gap.
Well, let's jump into that, because that's a big area of focus for our team at the Yale Initiative on Sustainable Finance. In fact, we've just put out some months ago a white paper on what might be required to do exactly what you're suggesting, to bring standardization to this world of ESG metrics, because it is a problem, frankly. The metrics are not on a structure that's in any systematic way comparable across countries, across companies, across industries. So we do have a very tough time of separating out leaders from laggards, understanding what best practices look like. You know, our answer, and for those who want to look at this in detail, I think we just dropped into the chat the link to our white paper. Our answer was there needed to be, at the government level, agreement on 3 tiers of reporting. A top tier that all companies, publicly traded and private as well, would report on with regard to a core set of metrics. a second tier that would be industry specific, recognizing that the issues in banking are different than the issues in mining. And the third tier would be a platform that would allow companies to tell their own story in their own way. Sort of one of the things that I've been arguing is that the world is facing a transition. This is at the core of what I think is required to help the investor going forward. And there's going to be fundamental change required in many industries. And I think from the point of view of asset managers, investment advisors, and the investors themselves, the really big question is which companies are getting serious about the transition to net zero, but more broadly to a sustainable future. Which companies are developing transitions in their business models, and what's the vision, what's the strategy, and then what's the plan for execution so that this company will be a success out over time as the foundations of the economy shift. And it does strike me that that requires not only kind of comparable data where we can do benchmarking, but some ability to read into and study the management strategy and to make judgments, which is what of course, the investment world does every day about who's going to actually deliver, who's going to come out the other side of this transition in a position to flourish in the changed world of 2030, 40 and beyond. So I'm wondering what your sense is about how we solidify the ESG framework, or to use a phrase I've introduced, make it investment grade. Do you have a sense of how we get there?
Well, it's going to require a lot of coordination. I think your points are well made. Reporting consistency and transparency is critical, right? And the standardization of the ESG terminology, data, and analysis is just so vital, to the point I made earlier, that we need our investors to have the confidence in the products and the investment vehicles in which they invest. And therefore, we as investors need to have the confidence in the plans that the companies present to us, right? When it comes to these topics. And there's a lot of information out there on ESG factors, on related risks, by a huge number of data providers and ratings agencies, but they often disagree. And there are gaps in the available information, which then also means that a lot of investment houses, including ourselves, develop their own ratings. But it creates a lot of confusion in the marketplace. Then when it comes to the companies, again, the companies are not reporting and haven't been asked to report in a concise and consistent manner. I was reading a stat from the IEA, the International Energy Agency, that was showing that I think 40% of companies with net zero targets have offered almost no plan for how they intend to achieve these. Now that's a big number, and I think that the other 60% that are offering a plan, there will be a lot of variation around that. So to me, now, the good news in all of this is there has been an increased focus on the part of policymakers and regulators, which is a step in the right direction to ensure global consistency and coordination. My wish list is that those regulators actually coordinate internationally, so that we're not going to get, because my fear is, of course, that we're going to get EU regulation, US regulation, UK, and so on, and Japan, China, and so on and so forth. So to the degree that regulators can actually coordinate and make this a global effort, I think that's going to be hugely important. And the other thing, to your question on investment grade, one item that we believe is very important to recognize is there's a risk that at times regulators oversimplify in the current approach to the process. So for example, what we're seeing is that the existing requirements do not fully address the differences between asset classes where there's a lot of nuance, and that might therefore not necessarily capture the full range of risks. So again, as we're looking for standardization, what we wouldn't want as an unintended consequence is sort of oversimplification. So there's a lot, I think there's a lot to do here. Just want to pause here for a moment.
No, so I want to dig in. I think you're quite right. We already do have a EU directive on ESG reporting that's coming. There are reports from our American Securities and Exchange Commission that there is work underway on a narrower framework of climate change reporting. And I think you're quite right. There's a real risk that these different reporting frameworks start to be misaligned and add to rather than improve the situation. My wish, and it sounds like you might have a similar vision, is that the regulators, perhaps the stock market regulators across the world, get together and coordinate on this core framework. And there might be some small variations place to place, but if you had the core framework agreed upon in common, it would be enormously valuable and give us, I think, that that ability to do some apples to apples comparisons and really understand what leadership looks like on sustainability broadly, on climate change in particular.
No, I agree. I agree with you on that. I think that is definitely on my wish list. And I would also say, to take, for example, the TCFD, right? The Task Force for climate-related financial disclosures, right? We're supporters of this. Newton is an insider, two of our investment companies, and BNY Mellon as a whole is, and we produce a report. But again, it's all done on a voluntary basis. And therefore, I suspect with time, you may see some you're going to see some deviation. And what would actually, I think, be better if governments are going to start looking at these disclosures and put them in legislation so that, again, companies around the world can disclose and report in a consistent manner. So it's the stock market regulators, the governments, it's a number of them.
Well, our team at Yale has been digging into some of these frameworks, and we agree with you. The TCFD is an important step. Mark Carney deserves credit for having brought to the world's attention the value of having companies speak to their climate change exposure, particularly the risks they face. Our view is that one wants to get an equal commitment of resources to upside potential. Who are going to be the solutions providers? And frankly, you highlighted our real criticism of this, which it has no underlying methodology. So people can report in their own terms and in their own ways, and as a result, have no comparability. So when I, by the way, highlighted the need for a core set of metrics, it includes methodologies underneath those metrics so that everyone has to report consistently. And that leads us to a first question that's come in from the audience. And I would encourage everyone listening in to now put questions in the Q&A function on the Zoom screen so that we can push some of those on to Hanneke to consider. So here's a question that's really very much related to what we've been talking about. And that is how can we get standards that are standardized not only by companies, but with their suppliers and getting the same kind of data from investors to company. And this is Anastasia O'Rourke saying it seems like there's a huge gap between how companies manage these different flows across the value chain. But that seems to be very much what you're calling out. Am I right, Hanneke?
Yeah, no, it's a very good question. I think the challenge, you're absolutely right, Anastasia. Companies need to have a holistic framework for this. So companies, it's not just about their own goals, but they also need to apply that lens to their suppliers, to their vendors, and they're increasing to their clients, by the way, as well. Who are you accepting as a client? Who are you accepting, or who are you working with as a supplier? And what are their ESG credentials? Because depending on what those companies' values are and goals, actually that's going to have an impact on your own company's ability to deliver on your goals. That's not always understood or implemented, but I think does need to be part of that framework. But it still doesn't take away from the overall issue that you and I have been talking about, then, that everyone needs to be able to deliver against a sort of standardized framework and methodology of reporting.
Well, and the particular issue that's being called out on our Q&A board is this issue of Scope 3 emissions. And frankly, one of the things that's distressed me, and Hanneke, I'm interested whether you think this will stand, is that a number of oil companies have announced net zero greenhouse gas emissions targets for 2050, but it's for their operations. Of course, the real worry is not that oil companies are operating in a way that has a lot of greenhouse gas emissions. It's that they're selling a product that when the customer burns it, it has a lot of greenhouse gas emissions. So I don't know whether, this is really several of the big oil companies, Chevron notably, Aramco in just the last week have announced these net zero targets, but it seems to me they're missing the point by not including scope 3 within their view of what it is they need to do.
Yeah, there are lots of challenges with that, right? It's about the path to transition. It is about what you measure. And it's also about, so from an investor point of view, we look at this, it's also about engagement versus divestment, right? So what do you do when a situation like that arises, whether you agree or not? In our, we prefer the engagement strategy. We think that's more responsible because there's also lots of societal issues possibly, right? If you think about if we were to be switching too quickly from a fossil fuel based economy to a green economy, that's going to be quite costly, which might increase societal inequality. I mean, if we were to be successful in getting there very quickly. So all of those, these are not very easy problems to solve. And I think all these items need to be taken into consideration, even if you were to consider one particular company.
So again, sort of pushing beyond this with a question that's come in on the Q&A board. The questioner suggests that we're actually seeing added urgency and that the pace of change seems too slow. And even a target of net zero greenhouse gas emissions by 2050 seems worrisome given the crazy weather of the last number of months, floods in Germany, fires in California, increased intensity and frequency of windstorms across both the Pacific with typhoons and in the Caribbean with hurricanes. And the question really comes down to, isn't it the case that companies may be facing risk by delaying, and that some number of companies are going to be suffering consequences by the physical impacts of climate change in a way that might argue for both governments and corporations stepping up the pace of change? What do you think?
Yeah, I think depending on what sector you're in and where you're located, some companies may face risks that may materialize more quickly than they're currently considering. I do agree that when we talk about, just thinking about the overall premise of the framing to 2050, none of us should forget that a lot of the work, actually, the real focus is what are we going to do by 2030 and what do we need to deliver by then, right? And I think there's going to be a lot of energy in Glasgow on that topic, because the more we can deliver by 2030, the greater probability that the world will succeed in meeting its goals in 2050. And the less we deliver by 2030, the greater the likelihood that we won't meet that net zero goal by 2050. And I think that is really important, and that will determine the action. So what I would say to this question is, don't focus too much on 2050, almost irrespective of what your business is and where you're located. You got to start acting now, because if you wait until, say, 2045, it's going to be too late.
Well, this brings us to another question. As you know, Hanneke, we've got in our symposium today, not just folks from the finance world, asset managers, investment advisors, but we also have environmental leaders. We've got some corporate leaders, and we have a range of academics. And this is really a question about the role of the academy. And the question is, do you think that the professors who are in the world of finance are doing all they can to help sharpen the focus and understand these issues? Or do you see more that needs to be done? And I wonder whether this really goes to our partnership between BNY Mellon and Yale. We're trying to bridge that gap and ensure that we get a sharpening of focus in the work of our Yale Initiative on Sustainable Finance. But I guess, are there questions that you think the academic world should be digging into as we try to bring more clarity to this world of sustainable finance and sustainable investing?
Well, I think both academics as well as not-for-profit organizations, right, have a huge role to play in helping to define questions as well as do the research that is needed to answer those questions. Because in the academic world, you clearly come at it through the tradition of research, which will lend the answer a lot of credibility in a way that is going to be very difficult to achieve in the for-profit world. So I think both the academics, which is why we're so delighted with our partnership here, Dan, and I think you have already, you've already cited just in our the last half hour a number of, I think, very important papers that you have put out under your leadership, but I'm sure Yale has a lot more to offer. Other academic institutions as well are doing a lot of important work, but I would also highlight, as I said, the work that not-for-profit organizations do to answer these questions, often also in conjunction with academics. So yes, I think there's a big role to play here, and has already been played.
So let me ask you the big question that we sometimes struggle with, and I'm not even sure we know how to answer. And a lot of people seem to have tried, but not yet really come up with a definitive one. And that is, from your perspective, do sustainability focused investments outperform others? Or to put it another way around, should we anticipate improved shareholder returns from sustainable investing?
Yeah, that is always the big question that that people ask. And we believe very much that responsiveness is also about how you manage companies, right? So it's also back to this sort of what we talked about earlier, moving away from the Friedman doctrine. We believe very much that responsibly managed companies are better placed to outperform companies that are less responsibly managed over the long term. And why do we say that? Because if you don't manage your business in a sustainable fashion, it's going to create risk. It could have risks in your supply chain that you're not aware of, or that you're not managing. You could have risks from a diversity perspective. You could have risks in terms of not meeting your climate goals, and mitigating these, so there's two sides to this coin. It's about the outcome you want to achieve, but it's also about mitigating those risks, right? And that mitigating, if as a company, if you're able to mitigate the risks well, that can have a direct positive impact on financial performance. And that at times is overlooked in traditional valuation analysis. So we've seen this analysis and focus on responsible investment does represent tangible risks and opportunities that can materially impact intrinsic value and can lead to better returns.
So let me push a little further on a related topic. And again, this is a question coming in from our audience. And that is, do you see any difference in the effectiveness of engagement versus divestment in some sectors or in some companies? Or in other words, are there some companies or sectors where divestment might be the right answer for those who are concerned about sustainability broadly or climate change in particular?
So our belief is that engagement long-term is better. Actively managing the issues and seeking change on the issues which are material to the generation of long-term value, we believe is better. So even if in the short term, so fossil fuels often comes up, right? So even in the short term, it means that you remain invested in fossil fuels, as an example. If you work actively with the company you're invested in on its transition path and understand how it's allocating capital to change its business, then long term, you will actually create a positive, not only financial return, but also positive return for society. The fear is if you divest, that you will, that certain companies or sectors will continue to go on for some time without making any change. And are we then going to be worse off?
No, I think that's right. And it strikes me related to that there are some companies within tough to decarbonize industries that are now trying to start that transition process. And if one simply divests the whole sector, then you're not differentially signaling that some of the folks who are trying to make a difference and trying to modernize, we might even say, their sector, get wiped out along with everybody else. And I point to David Crane, who was the head of NRG, one of our big coal-burning utilities in the United States. He had quite an interesting vision of a transformed utility future, but his initial investments to try to bring that about didn't pay off quickly. The market became impatient with his subpar returns, and soon enough, he was out of a job. So it does strike me as a challenge here because there is a lot of impatience in the financial world and not much interest in, I think, at least to date, investing in companies based on their transition strategies. But you heard me say earlier, that seems to me an important thing to dig into with some focus on the detail. What's your sense of whether the markets are willing to invest in transition or whether they want to just abandon certain fields?
I think the market, it's hard to speak for the market as a whole, right? So it's about where we're seeing flows and then where you see returns. I do think, again, it comes back to regulation, standardization, how we're going to create incentives as well, right? For CEOs and management teams to deliver that transition. If they deliver good outcomes, you know, the money in the markets and the investors will follow.
Well, I'm not going to try to make you answer this, but I think it does bring us to two other points. One is that it's often the case that our markets have been short-term focused, and someone who's really executing a transition for a business, a whole industry, may need more than a few quarters to get that done, maybe even more than a few years, may need a couple of decades. And at least historically, the markets haven't been very patient with someone who says, yes, I'm investing now. Yes, short-term profitability is suppressed, but just you wait and see. This is going to be big 10 years from now. So I don't know if society is got an answer to what seems to me a structural bias to the short term, at least of existing markets. I'm not going to make you answer that, Hanneke. That's an unfair question, although you're welcome to if you want.
No, it's a challenge. I accept. It is a huge challenge. I mean, our whole conversation here is focusing on 2050, but even 2030, right? It is already a long time from the perspective of markets.
Well, I think you're right. Markets are interested. What's the Q2 of 2022 look like? And so it's hard for the market to take seriously someone who says, well, the real payoff will come, in 2030, 31, 32. But let me ask you a related question. At least I see it as related, and it goes to how maybe you think about the need for different skills in a world where people want to judge the sustainability performance of companies, where they want to have information around ESG metrics. And yet a lot of the banking world still is traditional professionals trained up in finance or accounting. Do you see a need for the banking world to shift towards a broader set of skill base in terms of the people hired to do some of this tracking and sorting out of who is leading and who's lagging when it comes to this ESG performance question?
Yeah, so sorry, I was tracking your question, and I was wondering if we were going to touch on the broader topic of diversity. I think
it is a question of diversity in part, which is to say, the people want judgment now, not just on financial performance, in the next 2 quarters, as we were saying, but really on the ability of a company to manage things like diversity of the workforce, like diversity of management, of boards, like the investments in human capital. And it may not be that people trained in the traditional banking skills, with MBAs, are the ones best positioned to sort out the right metrics for tracking those S or dimensions of the ESG platform, or maybe not even the E dimensions.
No, possibly not. And we are seeing that in finance, for sure, we are recruiting, as a generalization, more people from diverse backgrounds. And by that, I'm referencing now the skill, not the gender topic, or that often gets referenced when we talk about diversity. So it starts with companies themselves, right? Companies have become more diverse. If you look at boards in particular, a lot of companies have focused on getting more diverse skills on their own boards. And so if you're in financial services, You want to recruit some, not just financial services skills on your board, but you want to get some tech skills on your board, or maybe some marketing skills, or some cybersecurity skills, as an example, just to add a different perspective. And I think that's true for financial services and banks as a generalization as well. From the perspective of asset management, I can tell you a lot of our research analysts come from a different background. They're not all trained in finance. A lot of them actually come from a particular sector, and as such have relevant experience to evaluate companies. And I think the banks are starting to do some of the same as well from a skill-based perspective, but we're on a journey here. Diversity touches a number of things, whether it's gender, ethnicity, skills, disadvantaged backgrounds, and so on and so forth. And I think as a generalization, you're more likely to get to optimal decisions and groupthink. And I think most companies, including financial services, are on a good path. If you don't improve your diversity, you're just going to have a tougher time in the marketplace, whether it's the focus on analyzing ESG metrics or doing other things for your customers.
Can I ask you about a specific project that I think you've been involved in? And that's a group called Level 20. It's a nonprofit organization that's, I think, focused on trying to improve gender diversity, and interestingly, in a fairly sharply focused category of European private equity. What's the thinking behind that? How did you get involved, and what's the game plan?
So I got involved because I spent actually most of my career in private markets rather than in public markets. And when I left private markets sort of in 15, one of the things that I had observed as I'd been CIO of a private markets firm is how few women there were in the private equity industry, and how few actually made it to sort of executive management level. And that was something that I thought should change. If you look at, similar to what we were talking about earlier, you go and look at companies that have more diverse executive teams. And I thought that private equity, as they go into due diligence, should start to actually meet the makeup of the companies that they were looking to buy. And the real question was, well, how does the industry actually do that? So I found it with 11 other senior women in Europe. And quite frankly, we decided to start small. We started in the UK, and we now have, I think, about 10 chapters around Europe, but have as PE sponsors a number of organizations that are also based in the US. And it's around a mentoring program, and it's around giving the sector a lot of support to keep women in the private equity sector. And I think there's some things we've learned. There are things that I have learned that I've also been able to take into my role at Newton and subsequently into BNY Mellon Investment Management in terms of what you can do and what is effective.
So I want to go back to a topic we began to talk about earlier, but it does go to this question of what you see yourself being able to do, what you think BNY Mellon is doing. And one of the areas that's grown recently is green bonds. And if I have my numbers right, BNY Mellon has in recent years administered now some hundreds of green bond issuances. And at least in one or another of the recent years, it was, I think, #1 in terms of global share on green bonds. And I want to ask you what you think the potential is for green bonds, and are there risks that this industry is not tightly enough regulated? And some people, maybe not yourselves, but some are kind of putting a label green on issuances that might not have as much structure as you would like. Is there a need here for the marketplace to be more careful about that?
So sort of two questions, right? So first of all, the market itself, how it's developing, and then secondly, sort of is the greenwashing also?
Is it a risk?
Is there some risk in the green bond market as well? I think there's a couple of things going on. Firstly, when you look at the demand, why are there more green bonds? And yes, we have BNY Mellon has really been leading the charge here, but we also have on the investment management side in our investment manager Insight we actually invest in impact bonds as well, and I can come back to that. First of all, I think fixed income investments can target, what's been interesting, we've learned that they can target sustainability outcomes in a way that other asset classes, for example, equities, cannot offer. And the headlines typically focus on equities, right? Because that's about all the things we've just been talking about then. It's about active management, it's about shareholder engagement, having voting powers, and so on and so forth. Having said that, the debt markets actually provide finance to a much wider range of entities, right? Public and private. You can have a public debt issuance of actually a private company as an example. So you can access projects that you can't always do through the public equity markets. So there's actually greater opportunity, but I would also say also in fixed income, there is opportunity for dialogue, right? It occurs differently, but there's opportunity to influence. And I think that has become increasingly interesting. Then the other piece of it has been that the scope of eligible projects has increased. We've seen the supranational bonds. Now we're seeing more types following as more issuers look to demonstrate support for sustainable issues, but also to deliver investment returns. And we're seeing that the bond issuance can be linked directly to specific projects with a positive environmental and social impact. So you sort of see, you see that there's more opportunities to invest, there's more eligible projects, and there's actually greater diversity. Now, when it comes to the risk of how did you describe it? The risks around sort of the labeling, those risks aren't really all that different from what we're seeing in equities. That market can also benefit from a common language, right, for investors to pursue their activities. And I can tell you that, you know, when it comes back to Insight, the manager that I just referenced, it has its own framework. And this is just an example, just to make sure that the impact bonds that it puts in its sustainability portfolios pass their framework. And they have found that around 15 to 20% of the impact bonds that they have reviewed do not pass their test. Again, that's just an example, but it highlights the need that this market also has for a common language and standardized framework, which our colleagues at Corporate Trust are also seeing and working with their clients.
So one of the takeaways from our discussion this morning that I'm going to go away with is that we do need a framework around ESG metrics, but also around green bonds. And frankly, it seems like the flow of funds would be enhanced if there was greater clarity. People would be more confident that the things they're being told are sustainable really are. And frankly, the fact that some things aren't getting the sustainable label would be a signal to pull back from them for those who care about this issue. Do you see a potential for growth with a better framework? I guess that's implied in what you've said several times, but I just want to pin that down.
Yes, I think a better framework will really accelerate growth beyond what we're expecting today, because to your point, it will create the necessary confidence.
Well, and that's, again, one of the things we've found in our research at Yale is the lack of trust on the part of some investors. And frankly, the lack of confidence on their part of their advisors has kept some flow of funds that might otherwise be available to be part of this capital that we need for climate change or more broadly sustainability. So it does seem like we're converging there. I've got one other question coming in on the Q&A that I want to put to you, and that is, it seems, this is from Andy Yu, I'm paraphrasing his question slightly, but it seems like a lot of the real challenges for climate change in particular, maybe sustainability more broadly, come from the developing world. And yet a lot of what we're talking about is a framework that's been developed for and applied to companies in Europe or North America. Are we somehow letting through our gaze, through our screening process, a lot of what's going on in China in particular, but perhaps other developing countries?
So we, of course, hope that those countries come to the table as well. And I think that's, for one, as you know, Dan, a big objective for COP26. I was pleased to see that while President Xi Jinping is not going to be there in person, he will attend virtually, or at least that's what I've noted. And I think it's hugely important that China participates in those discussions, and that hopefully the countries that are participating agreeing to a framework, in particular China, India, Brazil, Mexico, would be very important contributors. Now, it's also true that investors around the world have relatively small allocations, again, as a general, asset allocations to those countries, and as such, through an investor lens today, probably aren't influencing the outcomes as much yet. But therefore, I think I come back to the point that we've been making, both you and I, then consistently, the importance for this has to start with governments. There has to be a coordinated response, and that has to include the governments of the developing countries.
So I think that is one of the stories that we'll see emerging out of Glasgow as well, that the world's success here can't be rested entirely on what gets done in Europe or the United States. China is a critical player. Everyone knows that. They've got twice the level of greenhouse gas emissions of the next largest country, the United States. And some other developing countries are rising. So it does seem to be one of the important themes that will emerge, and obviously will require attention out over several years. Hanneke, we're approaching the top of the hour and our end point, but I do want to ask you just one last question in case I have missed anything. We've covered a lot of ground, but are there any other big picture trends that you see in the world of sustainable investing, sustainable finance, that we should put on the table for discussion over the course of the day?
Perhaps one on it. Well, I think firstly, I think very quickly we're going to move away from beyond sort of this best-in-class ESG approach to a broader responsible investment and sustainable approach, which will drive a lot of product innovation. I think is going to present huge opportunities for the asset management industry. Now, from a societal point of view, I have one observation. I think access to technology is really, really important. And there are two reasons to say that. And one is not so positive, and something we need to keep an eye on is that access to technology at the moment, or the lack thereof, is creating a bit of a ceiling on the opportunities for young people from disadvantaged backgrounds or in the developing world to have access to learning, right, to a Yale, because they've all had to learn online and not everyone has had the tools to do so. Equally, I think technology has been, when you think about equality in the working world, has actually played a very powerful role to create a way of working that has helped to improve, to level the playing field and increase equality. And I think that's been a very positive outcome of the work experience that we've all had the last sort of 20 months. And I think there'll be more to come. But ultimately, the climate change battle is a battle that is looming large, societal upheaval as well. And I think business has a really big chance and opportunity to change behaviors and culture. And I think the investment industry will play a very big part in that.
Well, Hanneke, I want to thank you for an enormously wide-ranging conversation, a wonderful way to start our day and setting out a large number of issues that we can pick up in our more detailed panel discussions to come. And before signing off and closing out this session, I just want to call out to everyone that the next panel discussions begin at 1:15, so in 15 minutes. There are different links. So for those who are interested in panel one, these links, by the way, were sent to you, but they're also in the chat. So Nathan has put in the chat panel one on portfolios and sustainability as one link. Panel two on lingering issues in sustainable finance is on a second link, again, in the email that's come to you, but also in the chat if you need it. And I want to say a big thank you to all of you for signing in and being part of this conversation. Thank you for the questions posed, and I'm sorry for those that I didn't get to. But a special thanks, Hanneke, to you and the BNY Mellon team for giving us a great jumping off point for our discussion today. And we very much do appreciate your support for the Yale Initiative on Sustainable Finance and our collaboration on some of these important research agendas. So I look forward to continuing the discussion ourselves in the weeks and months ahead. And the panels do begin in 15 minutes. Again, thanks to you all, and a special thanks, Hanneke.
And my thanks as well, Dan. It's been a huge pleasure, and I really look forward to reading the paper on our joint research effort when it comes out. So thank you. It's been such an important topic, and I was glad to be here.
So we'll be discussing, as I mentioned briefly, that net zero greenhouse gas emissions pledge project paper in panel 2 coming up in now 14 minutes. And then we will later in the month of November do a whole session on the survey that lies behind that paper and what we're finding in the way of corporate pledges, what works, what doesn't, what's real, what's not, who's got a plan. As Hanneke indicated, we've got some number of companies that seem to be serious about it, some others not so much, but that's a big topic for the next session and the weeks ahead. Thanks again, and signing off, closing out our opening plenary session. See you all soon, I hope, at the next part of the program. Bye-bye.